In this video, we're going to take a look at both the pros and cons of dividend growth investing as well as income investing, and we'll compare both strategies to each other. Hopefully this video will serve as a resource for people who might not know which method would best suit them, or maybe it'll get you to consider a different approach to your current investing style. For myself personally, I hold a combination of both dividend growth investments and income investments, but if you watch my channel on a regular basis, you'll know that I lean more towards income investing. Regardless, in this video, my objective is to be fair and equal towards both strategies, because the truth is, each strategy is better geared towards different people based upon their motivations, how much they have to invest, and their stage of life. So with that being said, let's go ahead and get started. The first type of investing we'll focus on is dividend growth investing. This strategy revolves around buying dividend-paying investments that offer lower yields, but as time goes on, these stocks hopefully raise their dividends on a consistent basis over time. As you reinvest your dividends and wait for these companies to hopefully increase their dividends every year, your returns compound over time. This results in your dividend payments growing and becoming much larger later down the road. This style of investing is heavily reliant on the dividend snowball I've discussed a lot on this channel. The longer you're willing to wait, the faster your dividend payments will grow. When we're talking lower yields, they can be as low as less than 1% or probably up to 4% on the high end. Most dividend growth investors I know won't usually touch a dividend stock that yields more than 4%, but there are some exceptions. Dividend growth investing is also the most popular form of dividend investing, so there's a wider range of resources available for investors. So let's start with the positives that come with dividend growth investing. Although it's not true in every case, many of the stocks that have provided long-term dividend growth are more mature companies that have wider moats. This can potentially make dividend growth stocks safer than the higher-yielding stocks. It's important to keep in mind, though, that some of the alternative investments out there like REITs are required by law to pay out huge dividends, so they naturally have higher yields. But on average, the lower-yielding stocks are usually safer. Because these companies are increasing their dividends because they're still usually seeing revenue growth, they also usually see more share price growth than income investments do on average. That's because these companies aren't required to pay out huge dividend amounts, unlike the alternative investments that exist. This can come in handy if you experience a significant setback in life, like if you've been laid off for an extended period of time or you have some huge unexpected expense and your dividend income isn't high enough to cover you. Many high-income investments like BDCs and closed-end funds don't experience much share price growth and are relatively flat over time. But with these higher investments, if you're reinvesting your dividends, you'll still gain a lot more shares that you can sell if you need to. Regardless, if it's your goal to live off dividends, then selling shares would eat away at your ticket to financial freedom, but at least you'd have to sell fewer shares if you absolutely had to. Finally, many of the dependable dividend growth stocks that exist are often consumer staples. These dividends are more tax-friendly than many of the higher-yielding alternative investments. From a tax perspective, not all dividends are created equal. Consumer staple stocks usually have dividends that are taxed as qualified, whereas many alternative investments like REITs, BDCs, and closed-end funds are taxed as ordinary income. It's too long of a topic to go into detail in this video, but it's worth a Google search to understand the difference between the two. If you happen to be investing inside of a Roth IRA, then this point doesn't matter, since all dividends are tax-free in this account. When considering the downsides to dividend growth investing, the biggest negative by far is how long the process takes. Unless you already have a good amount of money from a young age, the quest to live off dividends following this method is a very long process. What I've seen happen to so many dividend growth investors is that after a couple of years, they realize just how slow the process is and they give up out of discouragement. Because of this, dividend growth investing requires a significant amount of patience and discipline. This strategy heavily benefits those who are much younger because you have more time for your dividends to compound into amounts that are meaningful. It's also not the best strategy if you're older and you only have a fixed amount of money to work with. For example, if you're 65 and retired and you only have $250,000 and you need to maximize your income from this amount, then investing in 1% yielding dividend stocks isn't going to be the best investing strategy for you. You'll want to search for much higher yielding options that exist, and you don't have 40 years to wait for your dividends to compound faster. So in summary, dividend growth investing is usually a safer strategy because dependable consumer staple stocks are the investments that are known for paying consistent dividends with growth. This strategy also results in potentially greater share price growth, so you can buy shares at one price and sell them for a much bigger profit if you ever needed to, assuming that you're good at picking dependable dividend growth stocks. Finally, it's also more tax-friendly compared to many of the income investments that exist. The major downsides include the sheer amount of time it takes for your dividend payments to grow into a meaningful amount. If you want to live off dividends faster using this method, it's going to take a significant amount of money to do this. It's also not a great strategy if you're not starting young. If you happen to be in your teens, your 20s, or even in your lower 30s, then you can invest in lower yielding dividend investments because you have many more decades to wait and allow for compounding. If you're older and you need income now, then that's another downside to this way of dividend investing. Now let's look at income investing. This strategy involves investing your money into stocks and funds that are already offering high yields. There's no waiting required for your dividend payments to grow as they're already high to begin with. Despite some people saying there's no dividend growth with income investing, that's actually not true. When you reinvest your dividends, you're buying more shares, and that's one of the ways that your income grows. Plus, some high-yielding investments do pay special dividends along with the occasional increase, but it's just not as predictable as some dividend growth stocks are. When you invest for income, you become familiar with a lot of investment types that the mainstream media doesn't normally cover. This would include the ones I've already mentioned so far, including REITs, BDCs, and closed-end funds. But there's more of them that exist, including covered call funds, master limited partnerships, and CLO funds, to name a few. So let's go ahead and look at the positives. Obviously, immediate high income is the first benefit. It takes much less money with income investing to receive high dividend payments. Even if you're not retired, if you're receiving a good amount of dividends, you can easily use the dividend money if you ever needed to in an emergency. I earn a pretty good amount in dividends, and I've used this money in the past to reward myself on just a couple of occasions. I don't want to interrupt my dividends from being reinvested too much though, but I like having another income stream I could tap into if I needed to. Second, nearly all the monthly paying investments that exist are income investments. This makes living off dividends easier because you won't have to someday budget by the quarter with your income. Income investing also exposes you to a lot more asset classes than traditional investors don't normally have access to. For example, REITs expose you to real estate, BDCs are basically private equity funds, and master limited partnerships give you more direct exposure to oil, and so on. Finally, with income investing, you're much more likely to achieve the goal of never having to sell shares of your investment to fund your lifestyle. The goal of all dividend investors, in my opinion, should be to never have to sell shares of a stock or a fund for your retirement. When you hold these higher yielding investments, you're getting the highest payments possible. In terms of downside, the biggest would have to be the tax burden. If you're doing this outside of a retirement account, then the tax consequences can turn off some people. I personally think the high income is worth it, but again, you can avoid this by investing inside of a Roth IRA. Another downside is that a lot of high-yielding investments are cyclical. While interest rates have remained high, REITs have been taking a beating in share price, but despite that, we haven't seen hardly any dividend cuts in this sector. Another downside is that some people don't like that there isn't much share price growth in their higher-yielding stocks and ETFs. You do gain a lot more shares by reinvesting those higher dividends, but in terms of that share price line, it doesn't get a lot of action for these investments. So in summary, high income means high cash flow, which can potentially turn into another meaningful source of income for you even if you're not retired. Many income investments pay monthly dividends and expose you to many different asset classes. And it's also easier to not have to ever sell shares of your holdings. Downsides would include the tax burden, which can be allayed by a certain degree by investing in retirement accounts if you wish to. The investments are also more cyclical and interest rate sensitive, and there's a lack of share price growth in these. So the big question is, which dividend style is the best? And the answer is simply whatever motivates you the most. There's pros and cons to both styles, and I personally like a mixture of both growth and income in my portfolio. I would suggest trying both styles and see which one you personally prefer better. For me, the high income that I can use even before retirement is what attracted me to income investing more. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.